Hi, I'm Mike Ward. I want to just spend a little bit of time talking to you about the hardest part of NPV type calcs, and that is the cash flows that go into capital budgeting. Now, in some senses it's simple, but people really get this wrong, and it is definitely the hardest part of what we do here. Now, it's nice to understand that there are two sources of cash flow, two basic sources, let's put it that way. First of all, there is the cash flow, not the profit, that comes through the income statement from the operations of the company or the project that we are looking at. Then secondly, there is the cash flows that are going into or out of the balance sheet. And these are basically the CapEx, the capital expenditure that one invests in the project, usually up front, although sometimes that can be at different times and over the first few years, maybe for a big project. And then the cash flows that go into the balance sheet in the form of working capital. So these can be inventory or accounts receivable or accounts payable, or maybe you need a little bit more cash just to fund this project. So this is just cash that relates to operations. So those are the main two sources of cash flow that we worry about. Now, sometimes, in fact, quite often, at the end of a project, one can sell the assets that you've brought in as well. So that, in a way, is a cash flow that's going to come off the balance sheet if the assets still have a value on the balance sheet, and there may be some tax issues that relate to that, and through the income statement. So let's go and have a look in a little bit more detail. Now, the income statement cash flows, first of all, the first one that we're interested in is what we call the net operating cash flow after tax, otherwise known as NOPAT. And here's the formula for it. NOPAT is equal to the operating profits, that's EBIT, times 1 minus the tax rate. That's what gives us NOPAT, actually. And then we have to add to that the depreciation. Now, depreciation is added because it is not actually a cash flow, but it affects the profit. And so we must add it back to get the actual cash flow. The cash flow took place when you bought the assets right up front, the CapEx, but we depreciate them. That's just an accounting process of actually accounting year by year for the use of those assets. And when I talk about depreciation here, the accountants can get a little bit complicated with this. We are just trying to keep it simple here. We're talking about wear and tear, what the actual allowable tax basis is for those assets. Now, I've put a little danger sign over here under the EBIT, especially focused on the interest here, because a lot of people get confused about interest. And so we have to worry about that. Now, the interest that you see, people say, but what about interest? Isn't interest also going to affect the cash flow? Well, we leave it out of the cash flow. You can see this is earnings before interest and tax. But in a way, it is a cash flow, but we include it in the discount rate. So interest after tax is included in the WACC, the weighted average cost of capital. We're going to talk much more about that later. But if you include it in the cash flows as well, then you're going to end up double counting. So do not include it in the cash flow, because otherwise, when you do the discounting, you will have twice charged for the cost of capital, for the interest portion of it at any rate. So that's a big warning. Then, as far as the balance sheet cash flows are concerned, it's fairly obvious that anything you invest into the assets, CapEx, is going to be an outflow. And so that includes the installation and commissioning of equipment. You can't treat that as, and I'm talking here about for tax purposes and for accounting purposes, that is part of the CapEx. It's not an expense, although many companies try to treat it as such. So all of this, the total of what you spent plus getting the machines and stuff actually working, is part of CapEx. And that needs to be depreciated. Wear and tear allowances need to be put through the income statement for that. So that's the first part. And then the second part is that obviously it's not just about the fixed assets that you put into a project. it's also going to require, generally speaking, some working capital. And so you need to subtract the increase in net working capital. That's also going to be a cash flow out of the business. So if you need more inventory, that's an outflow. If you incur more receivables, if there are more debtors, people who haven't paid you, that's also an outflow because you haven't collected the money yet. If you incur more payables for these are accounts payable, these are your creditors who are giving you terms, that's an inflow. And if you need more cash, just in terms of running the business, just operating cash we're talking about here, that is to be treated as an outflow as well. Just one other point to mention here. Generally speaking, if the project's got a life, maybe after 5 years this project ends, then generally speaking, we would try to decrease the working capital to zero. We don't want to have any inventory at the end. We might as well run it down to zero. We want to make sure people have paid us and we won't be buying stuff. So our accounts payable will also be zero. So you often see us winding the working capital down to zero at the end. So the last part of the cash flow is what happens if you sell the machine at the end of its lifetime or at the end of the project. And so I'm giving you a formula for this. So the cash flow that you generate from selling your assets is equal to what you sell them for, the sale value, but there's a tax impact on that as well. If you sell them for something which is different to the book value, then you have to pay tax on it. So we have to subtract the difference between what you sold it for and the book value, and we just knocking off the tax on that because that will be treated not as a capital gain actually, but as an operating profit. So this will be the operating tax rate on that. So here's a little example. If you sell an asset for 200 units, dollars, euros, rands, whatever, but in the books it's sitting at 100, then, and the tax rate is 20%, then the cash flow is equal to the 200. This is what you got from when you sold it. But you have to subtract from this the tax on the profit. So that minus that, sales value minus the book value, times 20% is going to be the tax. And so your net cash flow will be 180. So you will get an additional cash flow from the sale of those assets of 180. So that's the way this stuff actually works. Takes a bit of. In finance, we put all of these things together and we call this free cash flow. We use that term to distinguish it from other kinds of cash flow that accountants have. You'd think cash flow is cash flow, but it isn't. And so here is the formula for free cash flow, which is what we're really trying to work out. Free cash flow is equal to the operating profits, that's EBIT, after tax, so what times 1 minus the tax rate. And you'll sometimes just see us calling this NOPAT, net operating profits after tax. Then we must add back the depreciation that went through in the income statement. We must subtract any capital expenditure for the equipment. We must subtract any increase, notice increase in net working capital. And if we sell the assets at the end, we need to remember to add back the sale of those assets after tax. So that's what you need to practice. Now, I've given you a practice question here. This is the CAT TRIP 7E, and you can have a look at this. I want you to try and see if you can work out the net present value of this machine. This is actually what a CAT TRIP 7E looks like. It's a big dump truck. The E means electric. So good luck with that, and we'll come back to that later. And then finally, you also have the Sneakers case study, which I want you to have a go at. You're going to find there's some extra stuff in there which we haven't covered, but it's going to keep you on your toes. I hope you found that interesting.